Well, hi everyone, and welcome to Capital Raising in Bear Markets and the webinar hosted by Cake Equity. Thank you for joining us. Good afternoon to those in Asia and good evening to those who are joining us in Australia, which I think a lot of you are calling in from. So just to set the scene, so last year we saw unprecedented investment into startups with seemingly almost every sector notching new records of funding. This year, not so much. Venture funding overall is retreating amid public market turmoil with rising concerns about economic recession. Equity markets are down, led by tech stocks, and this is flowing through to deal flow in the startup space. So in this past quarter, venture investors have cautioned startups to adjust to a very different funding environment. Quite well noted, Sequoia Capital actually warned founders to prepare for a longer recovery period and to assume that capital will not be easily accessible as before. But despite this caution, the firm has also announced two new funds focused on early stage and growth companies. So an indication that maybe not all investors are slowing down. In today's session, we will explore how investors are responding, what are they looking for now, and what this means for startups needing to raise in the current environment. And for that, exploring these questions with us, we have a great panel, a good mix of investors, opinion leaders from the startup ecosystem. We have Mohan Balani, co-founder and CEO of E27. We have Michael Blakely, managing partner of Cocoon Capital, Jason Atkins, co-founder of Cake, and Craig Dixon, co-founder and partner of Accelerating Asia. So welcome, guys. Looking forward to a great discussion. My name is Natalia Tugel. I am director of the landing pad at the Australian Trade and Investment Commission, and I'll be moderating the session for today. To start, Jason, could we perhaps set the scene with some information on the Southeast Asia funding scene?
Yeah, I think you've set the scene really well, Natalia, actually. I think that it's been a bit of a funny half where we've actually kind of, in some ways, seen a record first half, but at the same time, we're hearing all this noise of, the funding environment being so much more difficult, which it is. And we're seeing a lot of, big funds being raised, as you said, and quite a lot of deals being done as well. But at the same time, the funding according to Tech Asia, funding deals in the first half, capital invested in the first half of 2022 was around half what was invested in the second half of last year. So we've definitely seen, a big shift there. In Australia, similarly, we had a 25% reduction in investment in the first half of 2022 versus the first half of 2021. So even though it's been a very good year, based on long-term trends, I think the key is, big change since last year, and how do we make the most of that, and how do we see, companies setting themselves up for success looking forward.
Got it. And I mean, just to start off as well, could we also do a round of introductions for the rest of the panel, and perhaps also share a little bit about the organization you are joining from? Perhaps we can start with Michael Blakely.
Thank you. Thank you very much for having me today. My name is Michael Blakely. I'm managing partner of Cocoon Capital, which is a pre-seed seed fund based in Singapore to invest through across Southeast Asia. We've also done one or two deals in Australia. Our focus is on deep tech and enterprise tech businesses. Great.
And we could go to Mohan Balani next from E27.
Thanks, Natalia. Hi, my name is Mohan. I'm a co-founder and CEO of E27. It's a tech ecosystem platform. So we work on programs and business matching services across Southeast Asia to help startups grow into new markets and raise capital. Also recently just started a network-driven early stage fund called Ovel to really capitalize on helping founders typically raising in the seed and pre-seed stages. Good to be here.
Thank you for that. Thank you. And we also have Craig Dixon from Accelerating Asia.
Hi there, Craig Dixon, Accelerating Asia. We are an accelerator VC investing in early stage startups across mostly South and Southeast Asia. No vertical focus, pretty open to any business model, and working a lot with other VCs in the region like Cocoon and the other folks to help accelerate startups and get them to that next level.
Great, thank you. And of course, Jason from Cake Equity, perhaps a little bit of an introduction as well.
Yeah, so we're an equity platform. So we're passionate about helping startups to create real value from their equity. It's quite a complex and confusing area, and at Cake, through events and partnerships and our product, we really like to make the whole equity thing just so much easier for startups. So yeah, we have about 1,500 startups using Cake now in 15 countries, and we're really keen to keep helping out in the Southeast Asian region. And yeah, so looking forward to the session. Thanks for having me.
Great. Thank you guys for the introduction, and perhaps let's just dive straight into it. This question is for everyone. Perhaps we could go around. What are you currently seeing or expecting over the remainder of 2022? And perhaps maybe just give a little bit of intel of how the first half of the year has been for you as well. Mohan, would you like to start?
Yeah, sure. Okay, so I think in a few ways, right? So what we're seeing is that first half of the year, there was naturally a large drop in terms of the number of deals, right? So we were discussing earlier the numbers about half, right? A lot of this was driven by investors just pulling back and just waiting, but also founders realizing that they're much better off doing some internal restructuring first, and then potentially waiting for a better time to get a value for the company that was better, right? But a lot of the good founders have realized that there are two ways they can approach this problem now. One is they're starting to do bridge rounds. So I've definitely seen a lot of companies do small-scale bridge rounds. I've also seen companies that have started to do, especially in the A round, like pre-Series A type rounds to lead up to a larger Series A in Q1 or Q2 next year. I've seen this primarily from companies in markets like India, where they're a bit larger and a bit more established, with the idea that these funding rounds would be used for future market expansion and consolidation opportunities. Or on the investor side, I think yes, there's some holdback, but I think there's a lot more activity in the seed side now, with the investors coming in and getting a bit more excited by what I would say fairer valuation terms compared to where we were maybe in the last 2 years. I've also seen a lot more investments in founders that have either left their previous companies, gotten laid off, or decided to start a new company in this kind of environment. And we've seen a lot of these founders raise fairly large, like I would say 2 to 3 mil type seed rounds fairly quickly with their close networks. So these are just just to throw it out there, some high level trends that I've been seeing on the investment sides.
Great, thank you for that. Michael, would you like to follow up on that question as well?
Yeah, I think so far this year, if we look at Cocoon, this is probably one of our most active years. But a lot of that, I think, to do is takes time to close a deal. So for the first probably quarter, the deals that we were closing were actually ones that we started in the prior year. So I don't think you're really going to see the numbers kind of see what the effect of like the winter is coming until probably the third quarter, because that's when I think, it normally takes 3 to 6 months to kind of close around. So it's in that time that I think you'll start seeing where the numbers actually lie. I think what I'm seeing is valuations for our portfolio companies are definitely being hit at the later round. I think at the companies that we're seeing has at the pre-seed stage and at the kind of early seed stage, they never really got inflated. They were always relatively reasonable. So I haven't seen a huge change in the valuations that we're seeing or that we're asking for. But I'm seeing a change in the later rounds and more kind of companies that are going from Series A to Series B. And where I see investors focusing a lot more now is less on just pure growth, but also in the, they want companies to be able to prove the ability to actually make money. Where beforehand they were kind of like, let's just buy market share, then we can figure out the model later on. I think now it's like, hey, you've got to be able to demonstrate that you can actually turn a profit if you wanted to. Not necessarily that they're asking you to do it, but can you actually deliver on it? Also, what I'm seeing is actually there's a lot of, and it's kind of going on with what Mohan said, a lot of our portfolio companies are building out their teams a lot faster than they have been before, because there's a lot more talent available. So many people have been let go good people that I think it's easier actually to build out the teams which actually can help them scale to the next round. And I think that the final point I would say is, I think investors have got money that they're sitting on. They can only afford to sit on that money for like 3 to 6 months. They've got to deploy it within 2 years, even though the fund might be for like 3 year, whatever. The model of a VC is that you've got to deploy that money relatively quickly. So I think people have actually seen where the world is going now, and they're just going on and they're just being, they might invest in a company rather than giving them enough money for 18 months. They might say for 24 months to give them a little bit more money. But investors now have got over the shock. They've supported the portfolio companies that needed to do the bridge rounds that Mohan had said, and now kind of, okay, we're going to invest now in companies, but give them a little bit extra firepower to get them through in case this does go on a little bit further.
Got it. And you mentioned a little bit about investors that are sitting on these funds. Why do you think that they're actually been doing that for the early part of the year? In your personal opinion?
Last year was a record. I mean, Mohan, you probably have the numbers. It was a record year for fundraising in Southeast Asia. And so, the way the fund structure is, you normally have a 2 to 3 year investment period where you have to do the initial investments. So, and VCs are probably talking out of turn here. So, but VCs care more about a lot of VCs care more about the management fees than they do about the carry. So their model is they've got to raise a fund every couple of years because they need to build on the money that they can get the management fees on. So they don't, they don't want to get to the end of their investment period and not have deployed all the money, because then they have to give it back to the LPs, which the LPs won't be particularly happy about. So fundamentally, you can see maybe maximum 9 months they'll sit on the funds, but then they have to get back to investing. And if you look at COVID, if you look at 2019, 2020, everybody said the winter was coming then, but then 2021 was a record year, both for investing and fundraising, because they have to invest. It built up the demand. They had to go out and then invest.
Great.
One of the reasons on that why I've been seeing them. So like all this capital is there, but why are they then not deploying it? So to jump in on that point is valuation, I think, is one key thing. It was just very, very difficult to actually value a company because there's so much uncertainty. So I think the last quarter particularly, so I think it's been earmarked since Q4 2021 that this was coming. I think the public market started to dip November, December 2021. I know on the All-In Pod and various places they're saying, hey, Elon's selling his shares when that's happening, like the writing's on the wall or whatever. And I certainly took notice of that. And so there's been a couple of quarters of this sort of coming, and I think the last 3 months particularly, we've just been in this critical period of uncertainty where it's just been very, very difficult to say, if a company was raising, I'd say $100 million valuation, is it now worth 90 or 80 or 70 or whatever? Like, what is it worth? And I think just that real uncertainty has been one big factor, which is why we've seen more bridges being done, as Mohan said, more safes and notes being used where there's less requirement to have full valuations done. So yeah, that'd be one thing I'd add.
Yeah, I know about that as well. I feel like people tied to the startup ecosystem are already pretty high risk takers and have good perspective in seeing sort of challenges as opportunities. And investor FOMO will always be there. So like what Michael said, the funding is there, they're just sitting on it and sort of waiting for that right opportunity. But I just want to go to Craig and sort of get your thoughts as well on what we're sort of currently seeing and expecting for the rest of 2022.
Yeah, thanks. I think all the stuff Mohan and Michael and Jason said are true. Maybe just a few things to add. One thing we do see as the public markets go down is that angels feel less wealthy, and that means that they tend to pull back as well. And so we have seen angels who are saying, I'm going to take a pause and see how the public markets go before I deploy into the private markets. It makes them feel less rich and have less liquidity. So I think there is a bit of kind of pause on the angel side. I think with regards to the later rounds, I think everyone's seeing that. The idea there also is related to public markets. So the closer you are to public markets, the valuations are compressed, and therefore the multiples are compressed. So I think one thing, founders can do when they go out to talk to investors as well is, take into consideration the multiple that the investor is looking for and make sure that, your forecasts and your plans and your financials can kind of fit that narrative. And that also will probably compress some valuations, mostly for the good. I'll second Michael that like our portfolio as well, we did not see dramatic inflation like you saw kind of in the US and some other markets, in Pakistan, for instance. And so therefore, we haven't seen a huge downtick either. So it's more like things are slowing down, deals are taking a bit longer, there's more due diligence. I'd say the other theme that I see generally speaking is much more focus on unit economics and businesses that can become cash flow positive sooner rather than later. And you're seeing a lot of these businesses like these 20-minute delivery and some of these other business models that I was always a little bit skeptical about that were getting billions and billions of dollars plowed into them, are now failing. And I think to Michael's point earlier, if you have a good business model and you have a good founding team, sometimes these markets are actually the best times to ever be a founder. If you can keep your business stable, there's a lot less noise, there's a lot less BS. You don't get these founders who are really good salespeople that don't have a real business, just like, taking capital and offering discounts and creating unrealistic business conditions. And so, real long-term stable businesses and folks that are running those companies can actually do very well by attracting talent, running their business off less capital, and needing to offer less discounts and also having less competition for customers. So there is kind of a silver lining depending upon your situation as a founder, where you could really take advantage of the situation, even though there's obvious negatives around, potentially fundraising and valuations and things in the short term.
Yeah, I wanted to talk a bit more about valuations because that seems to be like the main stop point or the bottleneck really when it comes to making these investments. And I think especially in times like in a bear economy, especially, I guess customers can get very picky with their spending as well. So sort of projecting growth can be quite difficult. And, growth is of course tied to valuation. So I just want to pick your brains a little bit more than, when you look at your startups or when you've been looking at your deal flow, how are you looking at valuations or what are aspects that, startup founders need to keep in mind when they present to VCs, in ensuring that they get fair value as well as they raise? And who would like to start? Maybe Michael, maybe you'd like to start?
Okay.
Yeah.
There's always that always that rocket. I mean, I think if I look at the companies that are coming to pitch to me, I've actually seen valuations have actually creeped up a little bit at the pre-seed and seed round. The reason being is normally how we look at what a company needs for like 18 months, and then we're normally looking to take about a 20% stake in the business. And that's about as scientific as it gets to when, because that normally we have, a lot of our companies are like pre-revenue, some of them even pre-product. So you kind of look at it more, that there's not a whole bunch of data that we can go for. The reason they've moved up slightly is we're funding for longer. So a lot of the companies we're backing are maybe raising for 24 months. They're obviously tighter on their costs, but at the same point in time, we just want to make sure that we fund them through what is going to be happening over the next. We see it more as a year than 2 years. So valuations aren't really done scientifically for us. In terms of the companies, when we're taking them going out to market, I think a lot of it is investors are being more picky. Valuations have gone on the top end. As I said, going to Series A, they were never that toppy, but what investors have become much more discerning. So their expectations and what you need to deliver to them. So they're expecting you to have your data room ready. They're expecting you to have financials which actually make sense, that you have actually the team properly built out, where beforehand, because there's such a competition for deals, they're willing to let founders get away with maybe not having everything ready, everything prepared, everything kind of like gold plated. Their now expectations, they're looking for the companies to be truly ready with the right numbers and the right team in place to back them. And then I think the money is there for them to back. So, if I was to give, advice to founders who've done that seed round, who want to go out and do that larger round, is expectation should be when you go out, you've got to have everything prepared. You've got to have the data room. You've got to have the right team in place, because that's where the competition, VCs are becoming more risk averse. And a lot of it is because if you think about the investors in Southeast Asia, the market, and Mohan, you're going to correct me on this, I'm sure, but it's really kind of since 2011 that the startup ecosystem, the VC ecosystem has been growing here. There's never been a downturn. So nobody has actually, nobody's run a VC has actually ever seen a market correction like this. I'm an old dude. I've been doing this since 2000. So I've gone through a number of things. So what Craig was saying, actually, this is the best time for me to be investing, which is why this has been the most active time, because I think valuation is there, but also there's less competition. Normally I'm competing with angel investors or some kind of smaller VCs, all of which are relatively inexperienced, and they've all kind of run for the hills. So I'm coming in now and I'm like, okay, this is the best time, because I also find that founders who raise money in difficult times respect every dollar they raise. So when they raise, I think, I want to make this dollar last like it was $3 or $4. When money is easy, like it was last year.
That's so true. That's so true. We just raised, and I'm like, oh my God, I'm burning money this month. I'm like telling my team, like, what are you spending that money on? You better be getting as much for that money as you possibly can. Like, it's incredible the intensity that it creates.
And the thing is, this will go on. So as you just said that, Jason, is that even when things get better, this mentality that you've got now will go with you. And so the companies that raise through a downturn, for me, always outperform those that actually raise in an upturn in terms of the respect for the dollar and how to make it last longer.
You have to make a lot of more hard decisions more often when there's a lot less money around.
No, it's definitely a different breed, I think, of individuals when it comes to raising during these times. So, but Mohan, how do you feel about that? Do you agree? Do you think?
No, so I really agree with Michael, right? Like I think we went through the upswing period. There was no downturn, and I think it's important for founders to get into the VC psyche at this stage too, right? Fundamentally, VCs need a return of capital. They have their LPs to report to, their capital to return to, right? So VCs need to see that pathway to exit. And I think in the mid 2000s, like in the 2014-15 period, it was easiest to see that because everyone was projecting forward. It looked very exciting. But today, because of the uncertainty, it's not so straightforward, right? And founders have to change. I'll give an example of a company, and I won't mention who, right? That was going to do a larger Series A in the later part of the year, decided to take a step back, and because of the market downturn, raised a much smaller round, like half a mil, right, for context. And the term sheet was at a much reduced valuation. Founder took the capital and proved the business and the model, right? And is now going out and raising at a 15 mil valuation, a much more significant upside previously, and is completely oversubscribed, right? So I think on some level, even in these times, right, taking a smaller amount of capital via a bridge round first, proving that the model works, and then using that case study, right, to justify how you as an organization can do better with more capital could be a good way to alleviate some of the concerns VCs have. And it's a different psyche from 5 years ago, where VCs were willing and able to just throw the capital because they knew that if they didn't do it, someone else will quite willingly do it, right? So I think that kind of shift in mindset that founders need to have on how to manage the VC psyche is critical and important. The other big thing is also the comparables, right? The public markets are kind of trashed. So having a realistic comparable just isn't there. And it is entirely not fair also to benchmark yourselves to the public companies because the corrections have been a bit too significant. So sometimes it makes sense to just reduce capital, raise first, restructure, or even manage costs a bit better. Look at ways to better innovate internally such that you can maybe increase your revenue top lines. I mean, we are doing that for E27 and remain as cash flow positive in the 6 to 9 months time frame for or as long as you can first, right? before then looking at capital raising. I think that might make a lot more sense to just wait and endure the pain first.
No, I hear you. Craig, do you have anything to add to this question?
Yeah, no, I think overall the theme really is a return to fundamentals. And so, there was kind of a rush into throwing money at high growth businesses. And now there's a lot more focus on things like retention and actual product market fit. So really taking a look at, what's your retention rate? Do you have leaky buckets in your funnel? Do you really understand the persona groups of your customers and how you're serving those? Who are your super users? Really understanding, look at cohort analysis. I think the investors are really digging a lot deeper into these aspects of these businesses, whereas before there was a lot of kind of vanity metrics flying around with tremendous growth rates at the top of funnel and leaky buckets at the bottom, and they got money anyway. So just getting into maybe a few more detailed elements of what Mohan and Michael are already saying. And then I also, certainly agree with the idea that you should show that you're a good steward of resources. And so number one, there's the financial aspect, which is like being responsible with the funds you receive, having a clear path to some sort of cash flow positivity. I mean, when I look at a startup, I say, what if they can't fundraise again? What's going to happen, right? And so, what is your answer to that? And most founders should have a few different ideas in their head. What if we can raise 100K? What if we can raise 500K? And what if we can raise, 2 million? And everyone will have a different number, but you should understand and be prepared for those. So right now you haven't raised anything. So you're on that track of raising, nothing or 100K. But if things go well, you have that plan B that can help you bring in resources and ramp up growth even faster. And then plan C is, hopefully things kind of settle down and the markets, are a bit better, and you can fundraise again in 6 months and get that larger check size. The other thing I'll just throw out there that I don't think we've covered yet is, especially in emerging markets, we're seeing pretty dramatic devaluations against the US dollar. And there's two major effects from a lot of our portfolio companies. Number one is, a lot of the reports and reporting is denominated in US dollars. So even if you're growing, you could actually see a decline in your US dollar revenue month over month, quarter over quarter. And so it's important to your stakeholders to, show them, maybe both currencies and not just the USD, because it can make you look terrible even if you're doing well. But number two, we're also seeing that affect the customer base where, a lot of these countries are importing pretty basic goods, and a lot of their customers are no longer able to afford their products. And so you could see certain persona groups drop off, and you might have to reevaluate who you're targeting for your customers, go up market a little bit, and just think about some of these dynamics, because the currency issue could get worse. The US might be only about halfway through federal funds rates going up, which means a flight to US dollars, which means probably more US dollar appreciation. And this actually does affect startup founders, even if a lot of them don't really think too much about it if you're in an emerging economy. So just something else to kind of make a founder's life more difficult and more complicated. But I think for many of those out there, it's something that you need to think about.
No, those are good points. I just want to also just talk a little bit about Accelerating Asia. You mentioned that you are sector agnostic, but are you seeing any growth in terms of funding towards a specific sector, perhaps, when we're talking about trends, even though in this bear market space?
Yeah, I think we're seeing a lot of the continuation of kind of the COVID, post-COVID trends that are continuing. So we're seeing a lot of like embedded fintech, and fintech is still, I think, considered pretty sexy with investors. We are seeing a lot of medtech as medtech has moved online. A lot of customer groups that would have never really used online medicine are now very open to that. So we've got, online doctor consultations in our portfolio. We have diagnostic services on delivery in our portfolio. We have pharmaceuticals on delivery. So pretty much, a lot of the major aspects of medical care as well. E-commerce as well, various types of different e-commerce have experienced dramatic growth rates, and that has not declined. So I think a lot of those trends we've seen continue. As a result of the downturn, I haven't seen dramatic differences in verticals, except what I mentioned earlier around a lot of those business models that I think were hot potatoes. People thought they could just shove onto the public markets eventually and cash out, like Uber and these 10-minute grocery deliveries where, you just get like one tube of toothpaste delivered in 10 minutes. And I don't know how anybody could ever make money off that. And I think people thought they could just shove that onto the public markets in a year or two or three, and everyone cashes out and the retail investor, pays the price. And I think those those business models are going away, and I think you'll see a lot less money put into those verticals.
No, got it. I mean, we are talking to largely a startup audience right now, so I'm gonna go a little bit now from the startup side of things. But like for Michael, for example, you mentioned that it's been a really busy year for you. Any specific sectors perhaps that you find most interesting at this point?
Again, because we do deep tech and enterprise tech, with deep tech, it fits out, doesn't get affected by what's going on in the real world, mainly because investors in deep tech like ourselves and the founders themselves, we have to have a much longer term view. So if you're looking at a fund that is focused more on consumer tech, they have a much shorter kind of window expectation of when the revenue is going, where the growth is going to happen. A lot of the companies that are in deep tech, sometimes I'm investing in companies that might not see revenue for 4 to 5 years. And they're valued in a very, very different way. So there are very few companies that both do kind of like consumer tech and deep tech. So for those that are looking, who are from deep tech, you've just got to know that you've got to go after specific VCs, because a generalist VC on a whole will never touch deep tech. That they might do enterprise and a bit of enterprise on top of consumer, but very rarely will you see a generalist ever go into deep tech. So, because deep tech investors that have a very, very different mindset. In terms of for like enterprise, we're still, I think like Craig said, like fintech obviously is very popular, logistics. It's actually a lot of sectors which have been massively hit by COVID and are recovering from COVID. They're looking about how they can become more efficient. So it's all about efficiency. And what we're seeing is if they can work in Southeast Asia, they can work globally. So we've actually got a number of our portfolio companies that, whilst they were very much focused early days and for Southeast Asia, they're now expanding into Europe and the US, because the pricing we can, they undercut. And also we've got lots less legacy in place than what our competitors have. So we can go in there and be much more nimble than others. But I think for us, I never really know. We don't, you have certain funds which are like thesis driven. And they'll say, we want to do quick commerce. They'll go out and they'll find one or two the top 2 companies in quick commerce. They believe and they'll invest in them. I think, Craig, you're along the similar line. We're people driven. So as long as they're solving what we believe is a real problem, and we like them as a team, we believe in them team, we will invest in anything, which is why if you look at our portfolio, it is all over the damn shop. But fundamentally, we've invested in the teams and then the problem afterwards. And then we kind of we only do a few deals a year. We don't do more than, in normal world, we won't do more than 5 deals in a year. I think this year we might do a couple of extra ones, just because also there are a lot less angel investors, as Craig said, out there. So there's more opportunity for us. And we've hired a couple of extra people, so we've got a bit of bandwidth.
Great. Just before we go to questions, Mohan, would you also like to add on the sector topic?
Yeah, so for me, I personally had a preference and interest in the health tech sector. And within health tech, of course, there are smaller pockets like your mental health. One of my more recent deals is an early stage autism tech company. So if we look at the expenses in a lot of these type of companies, right, they're very driven by a very serious medical issue that either the patient or the family member is having. And typically there's less price sensitivity around these issues, which has been my notice with health tech, right? So I've always looked at companies in this sector where price is less of a factor. And there's also if you look at it from a global, where humanity is going towards, there seems to be an increasing long-term problem towards that issue, but not enough good quality companies tackling the issue. Okay. But the other challenge is that a lot of these companies actually don't entirely exist in Southeast Asia. Southeast Asia's health tech sector is still early. So the kind of companies are more focused on things like telemedicine, marketplaces for doctors and the likes. So for those, it's really about post-COVID booms and ensuring that the type of services provided are tapping on a more up and coming younger crowd that is more willing to use online healthcare services, and making sure that the unit economics and the cross selling for all of these services are relevant. So it's a bit different comparing, like, let's say, US type health tech deals and Southeast Asia type deals. Yeah, so for me, that interest has always been in that sector, and I hope to do more of that.
Got it. Jason, would you have anything to add as well on the sector trends that you're seeing with the companies on your platform?
Yeah, nothing really to add above what the guys have said. I think we're sort of seeing really similar things with the sectors. So yeah, I'll let that one go. Pretty well covered, I think.
Yeah, no, I think we've had a really extensive discussion already, but let's just go into some of the questions that have come through. Sam Kerr is asking, and I think this is for Michael, in particular for deep tech hardware startups, where they are capital intensive, how should they restructure fundraising?
I'll mute myself. As I said kind of earlier, I don't think, if you're talking to deep tech investors, I don't think the market has really affected how they're looking at deals at the moment. I think the one thing that I've seen change, though, over the last like 2-3 years in particular, there is a lot more providers of working capital to early stage deep tech companies that there were ever before. So a lot of deep tech companies, they just go and they, oh, we've got to raise equity funding or kind of money from VC. A lot of this, the money that's being used is for hardware, as you said, and there's a lot of working capital providers out there that is non-dilutive, is reasonably priced, and I think, you know, a lot of our companies are now using this facility. So they might, you know, they might raise $1 million, you know, of equity, but they might be able to match that with a similar amount for working capital, which means that they can go a lot further with a lot less dilution going forward. And there's different types of providers offering different, so there's like Mitsubishi, which has done hardware. So if you're building, if you need a manufacturing like machine you're manufacturing with, they will provide the funding for that for literally like 2-3% a year. And they just have a call on the machine itself. Or there's other ones, if you need like IoT devices or whatever, there's like ChocoUp, there's Aspire, there's lots of other, probably Mohan, you can probably, or Craig, you can name a few other ones. They're providing it at about 1%, 1.5% a year. Actually, we just got one with a company I'm involved with Craig. They just raised $1 million working capital at, I think, was it 1.5, I think, a month, which is, whilst it's a little bit expensive, it's a lot cheaper than equity. And you would never have seen this 3 years ago. These facilities for startups, like for companies which don't actually have revenue or are just at the beginning of their revenue. So that's the one thing I would say. If you're a deep tech, that's what don't just think of equity funding as the only source of money out there for you.
Got it. Would anyone else like to add to that question on deep tech hardware? If not, we can move on to the next question.
I'll just not necessarily on deep tech, but I think alternative financing is really important for founders to look at. And so even if you're not deep tech, there's revenue-based financing. There's other ways to facilitate growth as you fundraise alongside your fundraising. And even 1.5% per month for a startup that's growing at 20% month over month on their revenue is a really good thing to look at. Another thing on that topic is managing your cash flows. And so can you push out supplier payments and can you pull in customer payments and generate more positive cash flow? Obviously, if you're a growing business, your top line revenue should be growing faster. So if you can push out those payments, you can actually grow your cash flow. And so when I was a founder, we were fundraising and eventually we got to a point where we were able to self-fund. We were generating about $200,000 in positive free cash flow per month, even though we were unprofitable, simply through good cash flow management. And so alongside the other aspects of like dealing with the bear market, look at your cash flow in detail and figure out where you can push things off, where you can maybe get access to credit facilities, where you can push off supplier payments. and then you won't need to give away equity as much. You won't need to spend as much time fundraising. You know, fundraising is a zero-sum game as far as opportunity costs. So you're either running and growing your business or you're out fundraising. You can't do both at the same time. And so if you're able to facilitate growth through other channels than fundraising, it's something to take a strong look at. And like Michael said, it's expensive to give away equity. Now, I don't want to knock investors. I'm an investor, and you know, I think we add a lot of value, and there's a reason why we exist. But there's a lot of other options out there. And I think to Michael's point, not enough founders are looking to that. They think this is the way I do this. I go to this investor, and then I go to the Series A investor. And there's lots of other things to do. There's bridge rounds. We teach what I call drip financing, which is just like every so often raise 50K, raise 100K on a safe note. I know Michael doesn't like safe notes, but a lot of my founders have facilitated like 12, 18, even 36 months of financing through just raising 50K here, 100K here, 200K here. Change the valuation as your metrics improve. You'll give away far less equity over time because you're raising cash as your cash flow needs change, and your valuation increases as well. Instead of having these super chunky rounds where it's like $1 million at a $5 million valuation, and then $5 million at a $15 million valuation. And by the way, by the time your cash is in the bank, your valuation is like 6 to 12 months old, because that's when you started this conversation. And so the investors actually, from an IRR perspective, getting a dramatic discount on their investment. Okay, I just went off on a huge tangent, so sorry about that. But
no worries. I mean,
Greg, I'm not even started on you. I so disagree with you, but anyway, that's it.
No, but I mean, I agree though. Like, I mean, I ran a startup before as well, and I remember the amount of time it's either you're growing your business or you're raising the money. Like, we pivoted our business model so that we would never have to raise again. So it's a lot of work, and lots of credit that goes out to all the startup founders that are persevering through. But on to the next question. Like, over the last few months, are you seeing more transparency and better reporting from your investees, or is the current market pushing best practices among startups or not? Jason or Mohan, would you guys like to take this question?
Well, we don't have investees, so I'm going to have to leave that to one of the VCs.
Yeah. I mean, for me personally, I generally just do either a quarterly or 6 monthly check-in.
Mm-hmm.
As a small investor and as an angel, right, I have stopped expecting regular updates from like the companies I invest in, and I just do either the quarterly or 6 monthly check-ins. And I think the one thing that has been consistent with the good founders is that, you know, they share the bad news as equally well as they share the good news, right? There's a certain amount of pragmatism, and this has been evident since the COVID period, right? That I have seen. But I do notice that a lot of them are more forthcoming with asking for help. They do reach out a lot more when they need a bit more support. In the past 2 years, I think a lot of the support that, at least for me, right, to the portfolio, was more on the mental side, you know, just helping them to figure out why some of the issues happen, brainstorming ideas, less on the pure hard fundraising parts. So that has just been my own personal experience.
No, that's true. I mean, I think it's important to be smart about adding when you add investors into your cap table. You know, in difficult times, I think for a lot of startups, you need strong moral support. More than anything else, actually. You need someone that sort of champions your idea and believes in it. So that's a great point. Michael or Craig, would you have anything to add to that about the transparency from your investees over the reporting?
I would say, actually, I would totally agree with Mohan. I mean, I've always, and this isn't like what's going on now, this is from the very beginning. At the stage that we're at, things never go according to plan. There's always surprises, and normally you have customer concentration. So you suddenly have a customer not paying you on time, and then it buggers up your cash flow. Investors will never really respond in a positive format if you haven't talked to them for 6 or 12 months. If you've given them no updates, good or bad. I think it's really important for you as founders, at least on a quarterly basis as a minimum, you send out a proper update, both good and bad, in terms of how the company is performing. A, because you can get help, but B, when things do go according to plan, or don't go according to plan, need that sudden like bridge round, which quite often can come out of the blue. investors are not just angels, but VCs are much more receptive. And quite often we can see what's going to happen, where you're going to be in maybe 6 months' time. You can start having those conversations at that point in time and actually getting a bridge round. And you don't have to take it. You can say, we might need a bridge round in 6 months' time. Let's prep. Let's get people on. If you go to them when the walls are burning around you, it's very hard to get them to actually help you. So I don't think this is just happening now. I think this is good corporate governance. Whenever you take on external investors, is be very honest with them. Investors understand if you're investing in startups, things don't go according to plan. What they hate the most is surprises or the feeling that you've hidden stuff from them. And, you know, especially if they could have said, and I've had this a number of times, oh, if we'd known about this earlier, I could have helped you out of this. But you waited until it's too late because you were trying to do it yourself. And this is where you've got to, when you take on investors, you've got to see them as your support, not as your enemy. And quite often founders feel like, oh, the investors, if things don't go according to plan, they're going to get rid of us. If that's how you feel about the investor, just don't take their money, because that's not going to be helpful for you. And sometimes it's the hardest thing for founders to do is say no to money. So whenever you're taking money from an investor, that I always tell them, I said, go and do due diligence on the investor. Go and talk to the other founders that they've invested in and ask them one very simple question. When shit hit the fan, what did they do? Did they stop picking up the phone? Did they stop replying to emails? Did they try and take advantage of the situation? Or did they roll up their sleeves and figure out and help you get over that period? That's the only question you need to ask. And if they do the last one, then you take their money. If they do any of the other ones, don't take their money.
Yeah, can I double second what Michael just said? And I've noticed also, right, a lot more founders are doing better due diligence on investors. I literally had a call last week about this, and I think it's really critical, right, that founders ask other founders, ideally if they have the investor on the board or they've spent a good amount of time there. And let's be fair with the investors, right? Not all investors get along with all founders. There are two sides to everything. But what most founders need to know is how investors work. How do they work in times that are good or bad? How do they support them? And more importantly, how do they not support them? And figure out whether that particular investor is the right fit for them. Because the money is a very small part. It's the 10-year journey, and that entire relationship and ups and downs with the investor that you're going to have that is really going to overshadow the pure capital aspect of the relationship.
Oh, that's a good point. Craig, would you have anything to add to this?
Yeah, I guess just a little bit of detail, but generally totally agree. I think with VCs especially, just figure out who's going to be on your board. So the VC is a company, and that's important. But what's more important is the human that's going to be the person you're interacting with. So just ask the VC, because it's not always the person you're negotiating with or dealing with at the time that's going to be the person on your board. I think overall, we're just talking about trust and establishing trust, for you to the investor, but also ensuring that you're compatible with that person and you have trust for them as well. For our portfolio companies, we require all of them to send out a monthly general update on kind of their metrics and basic updates, and that should always have an ask. And then quarterly, we recommend they do a call. And so a call would typically be just with investors. The kind of monthly update could involve a lot of other people that you might want to invest in the future, or other stakeholders. I think besides the communication aspect, which is really valuable, it keeps you really honest about your business, because every month you need to go through the information and figure out where you stand, what indicators are up, what indicators are down, green, yellow, red light for different areas. And so it really makes sure you can't ignore any fires that are burning really seriously. But otherwise, I just, completely agree to keep the communication open and establish trust and make sure you tell your stakeholders early on when things are maybe not going so well, so they can help you out before it's too late.
Great points. We have another question from Ravi. As a VC coming in at the pre-seed or seed round, would you see value investing in a startup through a SAFE? And if yes, which is better value for the VC? A discount or predetermined equity?
I think Michael wants to take this one.
Craig Bitey. Oh dear God, this is people like to wind me up. Craig, well, I'll just start this. Whatever I say, Craig believes the total opposite. We've had numerous debates about this. I hate safe and convertible notes. At a C round, at a proper C round, not at a bridge round, that's a different thing. But if you're doing a full kind of 18-month round, but a lot of that is to do with the way that Cocoon works. We only do, as I said, 5 deals a year, and we're very, very hands-on. The problem that I find with notes is that you've got an undefined, you've got normally the cap that you have on these notes or the valuation, you've got not what the price is now, but what it is going to be in the future. So you're kind of setting the bar earlier. Because we're very active investors, we spend a lot of time actually increasing the value of the businesses that we're investing in, which in theory we end up having to then pay for doing that work. So we normally go in and say, what is the value now? Which, as I said, the way we value a business is very unscientific. But then we're incentivized alongside the founders to actually grow the value as much as possible with the business. And another issue that you can sometimes have, founders don't know how much, especially if it's a cap, they don't know how much of their company they're actually giving away, because the expectation of the founders is that they always hit the cap, that the next round is always done above the cap. I can't remember the number. I saw some numbers, like 60% of the time, that the next rounds are not done at that cap, they're done at below the cap. So actually founders can find that they're actually they've given away more of the company than they actually expected. And also you have the second issue is if you're having to do notes on top of notes, so it's who has priority, who is first in line, and you have to get the prior investors to give up that first right to the next round, which is normally quite contentious. So for me, you're kind of storing up potential issues, and there's a whole bunch of other stuff there. But I think for me is if I was in the founder's shoes, I would focus more on getting the right investor and then going with how they feel most comfortable investing, what instrument that they feel most. Don't go and say, we will only do a note or we will only do equity, because you could be excluding a good fund. I would go out and find the right investor and then figure out what would be most comfortable for them and for you. Don't add an extra caveat, which will reduce the pool of investors that you can actually talk to. Go on, Craig.
I was just about to say, Craig.
No, I don't disagree with any of what Michael said. I think we just come at it from different perspectives, right? So we invest in 20 to 30 companies per year. We have a lot higher volume. We also want to help our startups get money from other investors much more quickly, because we don't invest big checks. So we typically invest like $100,000, and then we go out and we help them secure another 300, 400, 500K from Cocoon and other investors out in the market. And so for us, part of our motivation is speed of cash in your pocket. And Safe Notes, literally, we've had an investor get money in the bank within 24 hours of meeting an investor. So they met, they had coffee the next morning, they signed a Safe Note, and the investor wired 50K into their bank account within 24 hours. And you just simply can't do that with a priced equity round. You also have expense around, registering all the shares with the government authorities. And in Singapore, it's not that big a deal, but depending upon where you're located, there can be a lot of restructuring issues. On average, it takes 3 to 6 months for folks to get money in the bank from a VC. And so if you need money today, it's just really, not necessarily something that you can do. A lot of our companies do talk to VCs at the same time they're raising like a smaller early round with us and our LPs and some other folks. And then they close that VC round in 3 to 6 months, and then they get the cash 3 to 6 months after that. And that's completely fine. But I guess from our perspective, it's just a different tool for a different incentive, I guess. So for our perspective, it's super faster. And if you make a mistake, you can just rip up the safe and sign a new one that supersedes the old one. And a lot of founders don't really know what they're doing. And so they might make mistakes. They might use the wrong paperwork. They might use the wrong definitions. They might put the wrong, court system. I mean, I've seen it all. And if you have something like a safe note or a convertible note, it's much easier to fix it, because you don't have it all registered with the government authorities, and especially if you get the share numbers wrong or something like that. So I think when you have like a professional VC that can do the oversight, has like full legal services like, Cocoon does and like we do, it's fine. But if you're out there raising your own round as a founder and you're raising like 100K or 200K or 300K, I do think in many cases, it's easier for you just to go online, get a safe note template, get that signed, get the money in the bank. It's a legal contract, but you don't need to go through all the other hoops and things. And then when you do get that VC round, yes, the VC may have to do some cleanup, and there may be some back and forth, and that might happen. But again, I think just different tool for a different purpose.
Great. Well, we have about 4 minutes left, and I just wanted to close out a little bit with each of you sort of giving your tips for what founders should focus on in the current environment that they fundraise. If you could just give 1-2 points.
Sorry, can you repeat the question? You were a bit muffled for me. Sorry.
Oh, no, we have 4 minutes left. So if each of you could give 1-2 points on what founders should be focusing on for a capital raise in the bear market.
I'll go first. So
Yeah.
for me, it's looking for opportunities. So on the one hand, looking for opportunities internally. So how to create more efficiency, how do you improve your unit economics? What can you do to extend your runway as long as possible? The second one is look for opportunities out there in the market. I think every market has its own unique dynamics. And, there's going to be areas where capital are easier to get and harder to get. And so, just do your homework, talk to founders and investors, see what's going on, and try to put yourself in the best possible situation for getting yourself funded.
I'll give 2 tips if you're going out fundraising. One, it's a relationship game. So even if you're not actively fundraising now, try and meet with VCs for coffees or whatever, or get to know them so they get to know you. It becomes a lot easier when you go out to fundraise if there's a kind of relationship already there. Also, for the founders, go out and buy a book about VCs. One of the biggest problems for a lot of founders is when they're pitching to VC, they're pitching to us as a customer, because that's what you do 99.9% of the time as you talk to the customers. The reality is investors need a totally different set of information. And to be able to understand what that is that they want to hear, you've got to understand how a VC works. And I'm sure if I asked questions to a lot of the founders on the call exactly how a VC works and what motivates them, what drives them, and how the metrics work for how they make money, a lot of you wouldn't truly understand that. And I think you need to understand, they always say great salesman knows their customer. You've got your customer at this point in time is a VC. So you've got to understand what drives a VC and how they make decisions, because that will help you in terms of actually asking them for money by giving them the information they want.
Okay, I'll just give a quick tip. Actually, I think founders should really consider angel syndicates, right? Because in the past few years, there have been many founders or operators that have done well, that have all started some sort of a angel network syndicate, either among their friends or alumni of the company. There are smaller pockets of fairly active angel investors. Like a simple example would be the Kopi Kenangan groups, the Grab groups, that are willing to support founders that they know are scrappy and nimble, but are also very quickly able to deploy capital. So you don't necessarily always have to target just purely the VCs or just purely the angel investors. There are a ton of syndicate groups out there. And also because these groups are large, through the pitching to the groups and all that, there are secondary opportunities that could come along the way. So do some research on what are some of the more active angel investor syndicate groups around the region. You'll be surprised by how many there are and how active they actually are.
Ron, can you tell people where founders can actually find these angel syndicates?
So the challenge now is that a lot of them are, the few of the popular ones, your XA Angels, your Angel Central, Ascend Angels, are a bit more public. Some of them have a site and everything, but a lot of them don't, right? They're just WhatsApp groups, they're just private networks. So a lot of them just require asking other founders for help, asking angels for referrals and these kind of things. A lot of my health tech deals, for example, come from syndicate networks in the US, in AngelList, these kind of platforms. So I think just founder to founder having these kind of conversations can be really helpful as a starting point, because a lot of them are not very public.
And to close off, Craig, do you have any tips?
Yeah, I think just generally, I think Michael had a good point about, you're selling a product. So you're selling equity to investors. And I think a lot of founders don't really consider themselves to be the product, but you are. And so there's several aspects to that. There's the product itself, which is like the founding team and, the traction and the overall, momentum of the business. And momentum is something that you need to convey to get investors interested in investing in your product. And to Michael's point again, it's, they might meet you once and say, okay, this is interesting. And then after you send them an update and another update and another update, all of a sudden they're like, wow, this momentum is amazing. And then I also like the product, the team, everything else. And then the last piece of that is the price. And the price is your valuation or your valuation cap, whatever instrument we're using. And that's the price of your equity. And so these are the three levers, essentially, just like any other product. I think I wrote a blog on this about like how selling ketchup is similar to raising money, because you really are selling a product. The second part of this is make it easy to invest if and when they're ready to pull the trigger. So make sure you have all your paperwork in order. Make sure you have all your shares. If you have an ESOP that's done properly, you have a data room where it's very easy for an investor to just pop in and see everything they need to see as much as possible and as quick as possible. You want to minimize speed bumps for them writing the check. And just imagine it's you and an identical startup, and they have to choose between the two of you, and you have all of your stuff in order, and they don't. Humans are just generally a lazy species, and given the chance, we'll opt for the easier solution. And so make yourself the easier solution.
Great, thank you. I think we've had some really valuable points there for the startups, just how to raise, things to take note of when you're dealing with investors, and of course, reporting as well. We talked a bit about that. Thank you to the panel today for your time today. I think it was really useful, and I believe that's it. So thank you everyone who joined. Thank you.